Hello and welcome. My name is Ryan Johnson, and this is the Saltcast. Today, I welcome Paul Johnson and Dan Peisner. Guys, welcome.
Hey, Ryan.
Hey, Ryan.
Thanks for having us on today.
Yeah, I mean, it lessens the burden on me, so it's great to have you guys on.
Love it.
But Dan, the world traveler, it's been a while since you've been on the podcast, and grateful you can make time to be on with us.
Happy to be back, Ryan.
As you guys can see, there's light bulbs on the little refrigerator back there. Those are all my failed ideas I had today.
Oh, dang. Just three failed ideas? Not too bad.
Just three. I mean, you got to put them somewhere, I'm not ready to put them in the trash yet. But the idea that we've been stewing over about today's topic is a glow and ready to go. But I wanted to talk kind of about, and maybe we can cover this a little bit, but kind of what triggers a sales tax audit. Quickly answer that question, because we have a number of different podcasts talking about, everybody is, there's not any business that is really safe from a sales tax audit. But really, in our pre-podcast chatting, we talked about kind of the three different things that you could kind of reduce the risk of an audit, not, of getting away from not being under audit, but maybe like the three things to make you audit ready, like in preparation.
You want to make certain that you're equipped to handle the audit, right? Yeah. Maybe you've been under audit once or twice. Maybe you've never been under audit. Those who have been under audit, you don't want to have, you don't want to have the same bad experiences of being audited if you weren't prepared or properly equipped to handle the audit. Or maybe you've never been audited and you're like, I hope I don't get audited, knock on wood, right? But if I am audited, what are some areas in which I can be better equipped or prepared to handle the audit? I'm grateful that we have Dan on with us today, because Dan handles and does a lot of consulting and arguing with auditors, but also consulting and strategizing with our current clients when it comes to audits. So I'll turn some time over to Dan, but I think, Dan, tell us a little bit about ways in which we could encourage our listeners, if there are any specific ways that come to mind. I know there are a number of ways that clients can avoid being audited. If that's even possible, what are some areas or ways in which they can avoid it?
Well, thanks, Paul. So as far as avoiding being audited, it's kind of hard to know. Every state has their own special sauce for how they choose companies for audit. Truth be told, a lot of times it's a certain industry. A state will decide, we think this industry's got some definite issues. We're noticing a lot of people doing it wrong, so we're going to pull this NEICS or SIC code. Each state a little different, and we're going to take a percentage of these sellers, and we're going to generate audit inventory on that. And so we're going to construction has been one that the Texas has gone after for a while, and whereas Illinois is going after e-commerce sellers because they've identified that a lot of the local taxes are not being done right with Illinois' unique brand of ROT versus use tax, and so they'll generate a number of those audits and look at that issue. So it's avoiding an audit's very difficult, because if once you get big enough, by virtue of your revenue, you become more likely to be audited. If you've got a high number of exempt sales, sometimes that'll get you audited. Or if you've not been audited in a while and you suddenly you realize, I've overpaid sales tax on this issue, I'm going to file a big refund claim and get tax on all these exempt purchases. We see this a lot of times with manufacturers. The state will say, okay, great, we'll look at this, But let's see if you're doing it wrong on the sales side as well. We're going to do a full audit and see if we can't recoup some of this. So audit avoidance is very difficult to do. It's not like on the federal side where you can just avoid the home office deduction in some instances. Be very careful with the everybody knows the R&D credit can get looked at. So it's not quite so black and white as avoid these issues. For sales tax, it's a lot more random, and so I'd say it's less about avoiding an audit and more just being prepared for when that auditor does come knocking at your door.
Yeah, you for sure can, make certain that you're in compliance. You're filing and remitting your returns, you're reporting those correctly, you're not making, erroneous mistakes on the returns. You can make certain that, you're charging the applicable amount of tax. But at the end of the day, avoiding the audit, I mean, oftentimes just a luck of the draw. It's like playing audit roulette and whether or not you get stuck or not. So let's talk a little bit about the three ways in which we can, be more prepared or equipped to handle an audit, Dan.
Sure. So I think the first way is to make sure that make sure that your sales records are ready. One of the things that assuming that your sales are taxable in that state and it's not a pure purchases audit, one of the things that auditor is going to want to do is they're going to want to they're going to do a sales reconciliation. And that means they're going to want to see for each month if you said you had $500,000 in sales, they're going to want to see the records that underpin that. They're going to want to see backup for your gross sales they're going to want to see if you've got returned merchandise, they're going to want to see that. And so what we recommend is for every month that you file a sales tax return, put behind it the records that were pulled from your system that supported the numbers on that return, be it something out of QuickBooks, be it a sales tax report from an ERP system, but whatever was used report underpins that, especially with any kind of local tax identifying information. And one thing that's sometimes overlooked behind that, if you're making taxable, if you're making purchases in the state and you're buying from out of state and you need to accrue use tax, have all that detail also behind that sales tax return. Because if you are making purchases in the state and you're accruing use tax, if you don't have the detail to back that up, on many audits, what an auditor can do is just say, I see that you paid the money, but if you can't tell me what you paid it on, I'm not going to give you any credit for it. And we've had some unfortunate cases where the state essentially got free money, where it was very difficult to have them give any credit. So you want to having that ready to go at audit time is very important.
When it comes to those use tax accruals, it's quite alarming because you would think that the state would have a way in order to reconcile what you paid versus what they calculate or what they are estimating or calculating tax on, and then offset those. But it's surprising the state's unwillingness, I think, in certain instances to say, yeah, I can see you paid $3,000 this month, but I'm calculating you owed $6,000. And so you need to pay $6,000. It's possible that $3,000 was accrued on something you didn't owe on, and the auditor is not necessarily even concerned about what you remitted use tax on that you didn't necessarily owe, any overpayments of use tax. They're just concerned about what they deem as taxable and what you should be remitting use tax on.
Yeah, and in most states, there is going to be language that states that the taxpayer is required to keep adequate records. And so that's what they get you on is if you don't have records to document that, and it doesn't necessarily have to be in the exact format they want, but if you cannot substantiate what you paid it on, then a lot of times they can disallow that, because it does puts the burden on the taxpayer. And so sure. Again, it's a lot of people will try to rustle that up when they get audited, and it can be done, but it takes a while. It's a lot harder, and there's the risk that those records are unavailable, they've been lost.
Right.
That company you bought it from is out of business now, bankrupt, nobody to call. So it's just better to have those records ready ahead of time.
It's also surprising to me by the request of auditors to have you provide a copy of the sales tax return with the data. Because from my perspective, if the state of California is coming to audit me, surely they have record of the returns that I filed, and providing the data, sure, okay, but do I need to actually provide a copy of the return as well?
I mean, you can usually get away with not providing that. They do have that data. They've got a report that they pull right off the bat that gives them all that data. But for purposes of detailing your records as a taxpayer, it's always best to just have that return with everything behind it. It's nice, it's neat.
Yeah.
An auditor can, as they're paging through it, they can kind of trace it from top to bottom, and it's just much better for it makes it easier for them. And this is one of those instances where if you can make it easier for the auditor, it's going to make your life easier.
Amen to that. Okay, so we got sales tax returns and the backup to go with the sales tax returns. You got the use tax accruals that also support the returns, what you're reporting use tax on. What are the other two, Dan?
So the second item to watch out for is going to be your purchase records. And again, this may not be every taxpayer for every state. If you're only making sales into that state and you haven't had a single purchase, then you probably will not need to provide records. And I'll come back to that in a bit. But with assuming that you've got a physical presence in the state and you've got offices or you've got some kind of purchasing going on, or it's your home state auditing you, in a lot of cases, the auditor is going to want to make sure that you paid sales tax or use tax on every taxable purchase you made. And typically they're going to start with your federal depreciation records, which can be sometimes we'll often advise clients, instead of using the federal depreciation table, to use an actual asset depreciation table, so they're not getting things, actual non-purchased assets in there, anything intangibles, goodwill, etc. If an auditor sees it on a list, oftentimes they say, I assume it's taxable until you prove to me otherwise. So better to start with a much more pure list. So make sure for any of those that you start getting those assets ready. Oftentimes for smaller companies, the state's going to look at every single taxable purchase on a fixed asset list. For larger companies, they may sample some assets, but typically, especially for the large ones, they're going to look at it. So I'm not saying that you need to pull every single purchase you've made for 3 or 4 years, but certainly if you've got your documents off-site, once you get that audit notice, go put your request into Iron Mountain to have the boxes brought into the office. Start getting ready to pull things out of archive. Make sure you have an idea of what that process is going to entail for your document storage and document retention. And also when you get audited, make sure if your company has a document retention, document destruction policy, you put a notice you're being audited, and you don't know how long it's going to take, so don't go shred these records years. Preserve them until the end of the audit and any pertinent appeals. But get those ready. You don't know. Typically for expenses, things that are not fixed assets, the state's going to sample those, or even just look at a couple in a category and get comfortable. So you don't. I'm not saying just empty them all out and get them ready to hand to the auditor, but kind of get them ready so that they're at hand and ready when the auditor really identifies what they're going to look for.
For sure.
And kind of go from there. So that's.
I think you bring up a good point there in distinguishing when it comes to purchases. You have in-state expenses, fixed asset acquisitions, whatever they may be. But if I'm a California-based company, my headquarters are in California, and I'm being audited by Florida, and I don't have any presence in Florida, then I don't want to provide them my California depreciation, my California fixed assets, my California expenses. No. This is specifically related to Florida. We could talk strategy when it comes to audits on another podcast, but it's important to realize and understand your industry and where you're purchasing and using those goods or services you're providing, you're purchasing, and how it pertains to the audit specifically. So I think that's a good point, Dan.
And that actually brings up that point I said I'd come back to. One thing we are seeing in a couple of states is you can tell them that you have no presence in that state, because their audit process says they need to look at purchases and fixed assets. They may still want to look at some of them. The approach that we've kind of used on that is set the expectation that you'll let them see some of the purchases, but this is not a game of if you are missing this one invoice, we are going to automatically assume it somehow was in their state and not taxed. That's not the game we're playing here. This is not a gotcha. You are going to provide them just enough records to give them the peace of mind that you have no operations in that state.
Exactly.
And that's an area that some consultants may have another approach with, but I've found when that's come up that's kind of the easiest approach is get them understand what they're trying to do and get them past it as fast as possible, with setting the expectation that we're going to give you documentation to prove that it is as we say it is, but if something's missing, we're not going to auto default on this.
Yeah, for sure. No, that's good. That's really good. All right, I think that brings us to our third point.
All right. So our third point is kind of a combination. So we've talked about having your returns ready. We've talked about having your purchases. Now we're going to talk about having your taxability ready. And this kind of takes the form of two things. One, if you're not charging tax on absolutely everything, some kind of a taxability matrix that simply says why you're not charging tax. And that may be because it's a grocery item in some states. That may be dietary supplements. It was one that we've seen a lot with especially for e-commerce sellers. Dietary supplements may not be taxed in a lot of states. And so being able to say these SKUs are all dietary supplements makes things is going to be critical to have. And so a taxability matrix, and that comes into knowing your industry and knowing how that state should tax you. And then the other part of that is certificates. So if you did not charge tax on a taxable item, the state's is going to set that up until and unless you provide them with a valid resale or exemption certificate from that customer. And so you want to typically have those ready. Every state's a little different on certificates. Some will ask you at specific points. Some will actually issue you a form letter that says, you now have X number of days from this point to give me all of your certificates. If you run into that, give them everything in the kitchen sink, just so that you've met your burden. If not, some states will only say you have to provide, we'll look at your non-tax sales and pull a sample and say, give me certificates for these. And if you give them all this, and then they project based on that. So just be ready, have your certificates ready, make sure they are complete. I cannot emphasize this enough.
I was just going to say the same thing.
Purchasing departments get lazy on these, and they don't fill out the seller information. Sometimes they don't fill out their own information. They don't sign them. They don't date them. A lot of auditors
sometimes the sales guy who's trying to get the deal in, they're not as diligent either in making certain that certificate is complete. So
the sales guys oftentimes. Sales guys aren't trained on what a complete certificate looks like in many cases, that's true too. That's not a rag on the sales guys. That's not their job. They don't. So you want to look at your certificates, and many states kind of will, if you have a certificate ready at the time of audit, they will give deference to that. They'll give you they'll accord what's called good faith and say, it's, as long as you had no reason to suspect that this is not a valid certificate, even if it ultimately should have been taxed, we're going to let this certificate stand. Whereas if you any certificates you provide after they ask, or that you go out and get after that point and bring back, they can subject those to additional scrutiny, up to and in many cases including actually calling the purchaser and grilling them as to what was done with it. Exactly. And so that's having those certificates ready early on, getting them pulled, getting them ready, making, if they're not complete, if it's the seller information, sometimes I'll just tell the client, fill that out with your information since you're the seller. You should have done it anyway at the time. If it needs a date or a signature, I'd send that back and get them to do it. just for sake of completeness.
Yeah.
But those are some of the big issues that we've seen. Certificates, oftentimes they call them a low-hanging fruit for auditors, because if it's not complete, they can just disallow it, and that's easy money for them.
Yep. It's funny, the certificate game that auditors play. I mean, hey, these sales weren't taxed according to your data. You owe tax on them because I know you're selling, keyboards and mice, or so you didn't charge tax you should have. Well, I mean, I sold 1,000 of them to, this wholesaler. Clearly, they're for resale. Well, no, not clearly, because you don't have a certificate on file and you didn't charge tax. So yeah, you owe tax on those. So then trying to go back to that wholesaler to get the certificate after the fact, hopefully they're still in business, for one, but B, hopefully you can get a certificate from them at that time. Otherwise, yeah, you're going to be left on the hook from a tax perspective, plus penalty and interest that the auditor is going to impose because you didn't collect it at the time of the transaction. So having proper documentation, certificates, whether they're exemption certificates, you're selling to a manufacturer, is exempt from tax, or it's a resale certificate, you're selling to a wholesaler, or whatever the case may be, they can provide a lot of comfort, peace of mind, a lot of confidence when entering into an audit, as well as the taxability matrix you bring up, Dan. I think, making certain that you understand the products and services that you're selling and whether or not they are taxable. I mean, especially in the service industry, taxability of services just ranges. I think most people would think that services are exempt from tax, and by default, yeah, sure they are. But there are a lot of states that enumerate a number of services, and we're seeing an increase in that. So being cognizant and aware and mindful of products and or services that you're selling into the state, whether or not they're taxable, and having a simple matrix. Now, granted, the matrix isn't going to, be reason enough why you didn't charge tax. It's always got to default to the legislation, but it at least provides a roadmap. Hey, auditor, we're aware. We provide these services are not subject to tax, or these goods, whatever the case may be. I think it's wise.
Yeah, and to your point, I mean, that having a matrix. Let's say that you have one item that it turns out you were taxing wrongly. If you can identify that and specifically code that, you can make sure the liability, you can work with the auditor, make sure that liability is limited to exactly the item that you coded wrong. You can have that pulled out and detailed. That's something that you can identify exactly and not have that contaminate a greater sample.
Amen.
Well, guys, I think this is a great discussion, but I want to end this podcast with a quote from Abraham Lincoln. Okay.
Abe Lincoln.
So the quote goes like this: "If I had 9 hours to chop down a tree, I would spend my first 6 hours sharpening my axe."
Boom. I love that.
So it's better. The best way to fight a sales tax audit is to be prepared.
Mm-hmm. Got to make certain you go into the audit with a sharp axe.
Sharp axe.
Just
documents in order.
Yeah, just don't sharpen your documents. The paper cuts are bad enough.
Well, maybe if the paper was sharp, it wouldn't hurt so bad. Experiments to be had later. I mean, let me go put that.
I love it.
Light bulb on the fridge over there. That was one of my failed ideas. But guys, thank you so much for jumping on Saltcast today, and we hope to see you on another one.
Thanks, Ryan.
You're welcome. It's great to be here.
Thanks for having us.